In this presentation, we will enter a reversing entry related to accrued interest or interest payable into QuickBooks Pro 2020 or QuickBooks Desktop 2020. Here we are in our Get Great Guitars file. We currently have the open windows open. You can open the open windows by selecting the view dropdown and going to the open windows list. We're now going to be making an adjusting entry related, or the reversing entry related to accrued interest or interest payable to see what happened last time. Let's first be taking a look at the reports. Reports up top. We're going to go to the company and financial and scroll on down to the balance sheet standard. Within the balance sheet standard, we're going to be changing the dates in the customized reports area from 01/01/20 to 02/29/20. That should be the cutoff date, 02/29/20. And okay, that's going to be as of the end of February. As of the end of February, we will note that we had in the prior presentation the interest payable down below of the $25. Now, the interest payable relates to the fact that we had interest that had been accrued for which we had not yet been paid, and therefore we need to record it in accordance with the matching principle. We need to record the expense in the time period it was incurred. So we increased the interest payable here by the $25. And obviously it's a pretty small amount right here, but the same concept would be applicable no matter what the amount would be. It could be a material type of amount. So the other side of it went to our profit and loss statement. So if we go to the reports drop down up top, we go to the profit and loss statement, company and financials, then the profit and loss. We change the dates from 01/01/20 to 02/29/20. We then have the interest expense of that 621. If we double click on that, then we have the 25 here that has been increasing in interest expense. Now, what we're going to do now is reverse that. Now, for this particular loan, note what is happening here. For this particular loan, we're not going to pay off the loan until the end of the loan balance. At the end of the loan term, we'll pay both the interest and the principal. So then we can make that payment at the end of the loan. So what we don't want to have happen here is to confuse people. And the other way this could happen is that we could have a loan that's going to be paid monthly, and the monthly amount of the interest had accrued, so we had 1 month of interest or one partial month of interest. Now, the reason we want to reverse this is because we don't want to confuse the person making the loan payments. You'll recall, if I go back up, if we have our normal accounting system, we want to make our normal accounting system work in the most efficient way. Then we want to make the adjusting entries that will be in place to make the adjustments correct as of the cutoff date. If we go back to the balance sheet, then one system that we could have is obviously when the loan payments are due, then we want to make the loan payments in accordance with the amortization schedule. If I have to deal with an accrual process at the same time as making the loan payment, that could get more confusing for us, especially if we have two different departments dealing with the loan payments that are being made and dealing with the adjustment process. So we don't want then to confuse the normal accounting process. We want that to run as efficiently as possible. It's hard enough as is. We don't need to confuse it with adjusting entries. So what we're going to do is say, okay, we've made this adjusting entry. We're just simply going to reverse it then as of the first day of the next time period, so that then the person that's going to be writing the checks for the loan won't have to be saying, well, what do I do with this adjusting entry? How does that alter the check that I'm going to be writing? We don't need to deal with that if we just simply do a reversing entry of this accrual. That's what we'll do here. So we'll just reverse it exactly. You can see it went on the books as of the cutoff date, as of the end of the month, for the 25 increase in the payable, the other side going to interest expense. We will simply reverse that exactly as of the first day of the next month. Note that it doesn't mean because we're doing it as of the first day of the next month that the interest is due on that day. It's not. But we want to redo all of our reversing entries on the first day of the next month so that they're easy to see. We can easily see, hey, that's a reversing entry, happened on the first day of the next month. That'll make something kind of incorrect for some period of time, but that's okay, because what we're trying to do is be in a normal system for a bookkeeping system that is easy, functionable, logistically correct, efficient, and then make the adjustments that we need to do for an adjusting process at the end of the time period. So therefore, what we're going to do is we usually would do this with a journal entry, which would be to go to the company dropdown and then go to the make journal entries. However, this is an easy entry, and therefore we can use the ledgers for it. And so we're going to have to use the interest payable ledger as opposed to the expense ledger because it is a balance sheet account and we can only use the ledgers for the balance sheet accounts. So let's go up top. We're going to go to the lists. We're going to go to the chart of accounts. We're then going to find the payable account, which is going to be the interest payable with that $25 in it. Double click on it, which will take us to the register. We see the adjusting entry up top. We're simply going to reverse that exactly as of March 1st, 2020. It then is going to be, it was an increase before, now it's a decrease. So we're going to decrease it. The other side is going to go to interest expense, bringing down interest expense, which is funny. It's reversing, but that's because it's a reversing entry. So we're going to say it's going to be interest expense, and the amount up top is going to be $25. So it's going to be interest expense. It's going to be a reversing entry. We'll type that in there. It's going to be for $25. It'll reverse this one exactly. If I say save, then it's going to reverse this one back down. Let's then check out and see what happened with this. Closing this back out, closing this back out. Let's take a look at the balance sheet first. Within the balance sheet, we'll change the dates up top. We're going to change the dates from 01/01/20 to 03/10/20 and then say OK. Then if we go down to the payable account, it has now disappeared because it's back down to 0. We can then take a look at the trial balance by going to the reports dropdown, company and financial, accounting and taxes, and then take a look at the trial balance. And then within the trial balance, we can change the dates from 01/01/20 to 03/15/20. And then we'll see that interest down below in the interest payable, or the 0 in the interest payable. Double clicking on that, we'll then see the detail. It was at 25 with the adjusting entry. We then reversed it back down to 0. That will allow it so that when the bookkeeper does have to make the adjusting entry, when the accountant makes the adjusting entry, writes the check, they won't have to deal with what do I do with this reversing entry on the books. They could just write the check for whatever they need to write it for. I'm going to close this back out. I'm going to close this back out. Then let's go to the profit and loss. Let's change the dates up top. That's going to be 01/01/20 to, let's say, 03/15/20. And then we're going to scroll down to the interest expense. In the interest expense, we see that we have the $25 and then the reversing entry of the 25, reporting it as it should be as of the cutoff date, then reversing it afterwards so that the bookkeeper then can make whatever journal entry when they make the actual payment. Closing this back out. Also note that if we were to make the beginning date as of 03/01/20, then we see this negative interest expense, which looks funny. It looks funny there because it's a negative interest. It shouldn't be that way, right? But it's a reversing entry. And once the interest expense is recorded or the payment is made, that will basically reverse out. So if I was to open this up, you can see that's our reversing entry. That means, of course, that we will have, it's not a perfect system in that it won't make everything on an accrual system all the time. The adjusting system also isn't an accrual system. We're saying, hey, we're going to deviate from the accrual system to make our accounting system logistically easier to do. And then we'll make the system correct periodically at the end of the month or the end of the year by making adjusting entries and reversing entries. It's more efficient to do that than to try to be on a perfect accrual basis every day through the month.